Hit it.
It's Friday, February 14th, 2025, episode 258. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, it's a no guest episode. So for those who tune in for the wisdom of our guests and hit stop once they're finished, it's time for you to check out, and we'll see you next time. For everyone else, Patrick and I will chat about markets in this squiggly line segment, Talking Charts.
And to be double lame, I have no beer this week, and neither do you. We're recording a little bit early.
Yeah.
No beer.
Actually, in honor of Daniel, I'm drinking some tea.
Oh, very nice.
Yeah.
Lovely. That's very posh of you, sir.
There you go.
Well, you know me. That's me. Very posh.
There
That
you go.
one's for Rupert. All right.
Okay.
Let me do the
do the side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include, and by the way, these are brought to you by Tyrone Bagums.
Yeah.
Doom porn addiction, something Patrick suffers from.
I unfortunately do.
Yeah. Gold bed bugs. Oh, that's a bad one. And then the Stansbury shingles.
Oh, that's the worst. It's like it's just like you scratch and.
All right. Patrick, get us going here with Talking Charts. What do we got?
Okay, well, let's start off by talking about the things we were watching over the last couple of weeks, and that was inflation, how the earnings came out, and how the jobs numbers printed. And well, obviously, things got moving on the inflation numbers. Do you have a comment on?
Well, I would say that I probably screwed up the order there because inflation ended up being the number one thing with a hugely hot number. They were expecting 0.3 on a month-over-month basis. It ended up coming in at 0.5. But what's interesting, Patrick, is that it initially sold off. We had this big, huge decline, but by the afternoon, it was completely forgotten. It's like the market didn't care.
Well, I
feel like that, like that scene in Jurassic Park where the guy's giving the secrets over, and he goes, "See, nobody cares." That's what that feels like on the market on so many things these days.
But that's the shocker for me, actually, about this market's trade range right now over the last month. It's like literally the market doesn't want to commit in any way to any big market moves, and so it's one of these scenarios where the market bursts and then comes right back, and then just rinse and repeat over and over again. At some point, this market's going to break out, and it's going to be a big move. But right now, the last month has been fake out breakouts and just been churning. The interesting part of for me, I was watching earnings, and inevitably, at some point, earnings are going to impact the markets. But again, comes another earnings cycle, and it ended up being just right down the middle and not being a big market mover. I mean, obviously there's one big one coming up here, which we'll talk about in our top three. But at this stage, earnings have maybe obviously started the financials up on the upside, but the rest of the market was just a nothing burger.
Well, I think if you look at earnings, they actually did surprise to the upside as a whole.
Yeah.
Having said that, I think you are correct that even though they surprised to the upside, they did not end up pushing stocks higher. And one of the things that I do think is interesting is if you look at the next 12-month EPS forecast for the S&P 500, the growth is stalled and it's rolling over. And if we look at Mag 7, I thought that was super interesting. The other day, I pulled up the chart of that, and that is already, in terms of the next 12 months earnings, that is already topped and actually rolled over. So I think what's happened.
When does the market start to care?
Well, so it's going to be this is a more complicated discussion, but I actually think the market already does care, Patrick. For the first time in a long time, the rest of the world is outperforming the U.S. by huge amounts,
except for the Nikkei.
Yeah, it's still outperforming.
Well, actually, let's save that for the charts because I think that's a great conversation now. Because I want to kind of go and look around the world. We have more time than normal, so we have the time to kind of work our way around there. So let's talk about the top three things to watch. And I put the U.S. dollar, but particularly, we had an extraordinary move in the dollar, and we're now seeing a 1 month consolidation. The U.S. dollar is paused. and against the euro, the pound, the Canadian dollar, everything is this kind of fib retracement of like it just went too far and it's now mean reverting. But the interesting one is your favorite one, which is the yen, and the yen is actually behaving far more like it's a basing bottoming formation and starting up, or in the case of a US dollar yen, a topping formation that's rolling. And that one seems to almost be marching to the beat of its own drum. And so watching whether or not this is just a US dollar reversion and this is just going to pause before the resumption of the bull trend, or whether the yen is onto something and whether the US dollar has exhausted itself and is turning, is the thing to watch 100% for the next 2 weeks.
Well, and I
I
just like to remind everyone, our currency whisperer
Yeah,
nailed it again. He was telling you that you got to own the yen.
yeah.
The only thing I'd be scared about,
He's
Patrick,
whispering.
is that I'm adding to my US dollar short and writing a big piece about how I think the US dollar's rolled over.
Yeah,
So I'm
don't
gonna
go
be
through this.
wrong. So therefore, for all the bulls out there, you can thank me in advance.
I'll be straight up against the euro and against a lot of these, not the yen, but I still think the US dollar's got another bull impulse in it.
Of
I
course
think,
you do. Of
yeah,
course you do.
I
You
do.
always think that.
Well, we'll talk to technicals right now. Okay,
Okay.
number two is the tariff escalations. Will this thing just keep getting? Is this going to retaliate back and forth retaliation? Is this just going to keep doubling down? Like, are things going to just keep getting worse, or are they going to calm down? And it's like is a one big burst and
Nah, flood the zone. Steve Bannon's already told you. Flood the zone. It's going to continue to be lots and lots of headlines. The
yeah,
only real question is there any substance to it? Do any of these end up coming and actually taking part? But in terms of more headlines, they're
yeah,
going to keep coming.
yeah.
They're going to keep flooding the zone. The playbook is clear.
All right. So and number one thing to watch is NVIDIA's earnings.
Yeah.
And
What do
so
you think?
let's Uh, well, I think there's no more important one of an earnings here. I'll pull up the chart, but the obviously from a technical perspective, what happened with the deep seek uh, gap on the downside is it really has asked the question as to whether Nvidia has put in a topping formation. The interesting part is that since a week of weakness afterwards, it's now mean reversion reverting back into the gap fill. So it's trading right at the 50-day moving average, right at the filling the gap moment. And so the earnings actually, I think, will be an incredibly important tell because if for whatever reason NVIDIA breaks down on its earnings and it's a disappoint, uh, then that is a major top for NVIDIA because a failure to make higher highs, rolling over its moving average, and then a breakaway gap that fires off the downside will usher in a round of distribution, and that will be it. So while I'm not predicting that, I think there isn't a more important earnings than this one. Because if the bulls want to keep it going, then the Nvidia needs to, in some way, say something positive that spurs the bulls to get this back up to 150 and then reopen a new bull cycle where this thing is going to act like a leader again and drive a new move. Which one are we about to get is the single biggest thing to watch. I don't know if I have a strong conviction. You think it's going to break?
Oh, I don't know. I just think it's interesting. In my weekly wrap up at the end of each week, I include this chart that is basically the S&P 500 at the money forward implied volatility by
Yes,
day. And
by
I
day.
think it's
I love that.
fascinating. Like you could see the days, like for example, CPI, it was 3% higher, expected 3% vol points higher than the average
Yeah.
over that period for the next month.
It's the single most important
Yeah,
price event coming
it's
up.
more important. Nvidia is 6% on the S&P 500, six vol handles higher. Its unemployment report is only 4, CPI was 3, and yet the
Yeah.
Nvidia was 6. It shows you the importance of this one stock to the entire market.
Yeah. And so we're about to find out in the bigger context of what's in store for the market next. So let's actually take a look. I want to go all over the place in today's talking charts, but let's start off just with the equity market since we're here right now. And so clearly the S&P 500 has rallied back up to their highs. And I know this one guy that always says there's no such thing as a triple top. I don't know. Do you know who I'm talking about?
Don't know. That guy
Uh,
sounds like an idiot.
yeah, probably. But there's a very good chance that this market is going to take a stab at a prairie dog at minimum, where like it's going to there's this overhead resistance, and there's nothing better than the headline of the S&P hits all-time new highs that printing right across the board. I think there's a very reasonable chance we just, even if it's not a sustainable breakout, that it just occurs from this for the sake of happening. And so a breakout here can happen, but I asked the question, what is it that could make the breakout sustainable? One where the S&P goes and starts ripping up to 64 or 6,600 on the upside, that we have another full bull impulse. And so I want to look under the hood and sort of see where that would have to happen. Well, first of all, I want to just highlight how the whole S&P is doing. First of all, just let's look at the market breadth. And the breadth of the market, which is the number of stocks on the S&P 500 that are trading above their 50-day moving averages, we're still at 55%. Basically, let's call it a wash. Like 50% up, 50% down. And so we don't have a widening breadth. Now, if the market's going to sustain a breakout, and especially if the Mag 7s are not going to be the major leadership on the way up, we have to see a massive widening of breadth, right? We need a much larger participation on the upside. Right now, up till now, it has not been the case. But if we are going to see a sustained rally, this should come with this making its way to 70, 80 plus percent as as you have a much broader participation. And so where that could be most evident would be on this equal weight S&P 500 index. And so when we're now looking at it from an equal weight perspective, the S&P hasn't been equal weight. It's been a massive laggard, in spite of the fact the Mag 7s are doing nothing. You're seeing a scenario where we have gone nowhere near those November highs, and we're sitting right at the moving average, right at a Fibonacci zone. And the thing that I'm looking at is that imagine a scenario where the S&P breaks out, but it's not got widening breadth where the equal weight is doing its share. Well, then that's going to put the job of the market rally completely on the hands of the Mag 7s, where like you're going to have the broadening of the whole market and it's going to push it, or you need the Mag 7s to reestablish themselves as leadership, and they're using their market cap behemoth weightings to actually push the index higher. And so when we look at the Mag 7s, though, they're massively lagging. They're stuck in an awful trade range. And stocks like, for instance, Microsoft are showing zero pulse. They're not even reacting off of its lows. Now, Apple did bounce, but it's bouncing right back to a previous high from January, where this is not exactly a given that Apple is about to break out to a fresh new bull phase as it, let's say, runs to 270 on the upside. So what will be is it Tesla that is going to here try to turn back up? Like when you go across all of the Mag 7s, it's hard to find the 3 or 4 Mag 7s that are setting up to be the leadership for a huge bull breakout. And so there's a lot of big question marks, right? If there are no Mag 7s that are ripping in a massive way and the breadth doesn't widen, then you have to believe the chances of an S&P prairie dog are very high, which is that it'll break out and then fade right off of that breakout high. And so in order for me to drink the Kool-Aid that the S&P is going to have another big leg higher, I need to see something under the hood on one of these metrics showing that where that real tailwind is going to come for the market. Any comments or things that
I
you
got
want
no
to go through?
comments. You know me, I'm way more bearish than you are in terms of like I don't even know if we get the prairie dog. I think that everybody is all in, that the sentiment is extremely lopsided in terms of when you look at long-term money, everyone's overweight. And for the first time in a long time, we have the rest of the world outperforming the US.
Yeah.
And
So-
to me, I feel like, yeah, we can sit around and argue about whether we're going to prairie dog or whether it's going to go up another 2-3%. But that's like missing the bigger story. The bigger story is that
Yeah.
Europe is up 12 or 14%.
Well, let's talk
or
about this. Okay.
China's flying. All these other things are going. So why?
Well, I don't know about this China flying. Okay, yeah, there are sectors like the tech sectors in China are flying, right? But okay, let's talk Euro stock because one of the things that I was originally looking for was that are we going to see a sector rotation when the Mag Sevens made their big when the Mag Sevens did their big push on the upside, there was going to inevitably be some profit taking, and the whole thing is going to inevitably lead to a cycle where there was going to be other sectors that were going to be the net benefactors, and financials certainly were the one of the areas that got that benefit. But one of the things that it was really interesting, exactly to your point, which was one of the big sector rotations was actually taking advantage of a very cheap euro and coming in there on these really deep value European stocks that are selling at much cheaper valuations and go on a major shopping spree. What's amazing is that the European markets just go ripping in the most extraordinary way. Big breakout like you're talking about. The question I have is how sustainable or how much farther does this European market have to go? And I want to take a moment to reflect on the breakout that we saw in 2023 into 2024. And you had a scenario where we had this extraordinary rip, but that rip happened in two very distinct legs. And I want to talk about the analog of how that would look if it played out this time around. So if you notice back over here, the first leg was about a 2-month, 600 point move on the Euro stock. And the second leg after this had this pause. It took a 1-month break, which is typical. Markets pause and revert when they're overbought. After that, the second leg ended up being about 700 points over again 2 to 3 months. It was a 2.5-month advance on the upside. And so we had these this kind of 600-700 point advances that all lasted about 2 months. Well, we're currently, depending on which low you want to measure off of, we're about 800 points into an 80-day rally, or basically almost 3 months. And so when looking at it on a proportional basis to the other legs, this is a market that's probably overdue for taking a break. And the last time it did that was about a 1-month market pause that basically didn't even do a fib retracement, just paused and then resumed. And so I think even though everyone's talking a hot euro, I don't think it's I think we needed to take a break and mean revert before anyone puts brand new positions to play in Europe. This move is already very mature on a relative basis, but that doesn't make it a short. I don't think you don't go and short the euro here, euro stock. It's likely to pause, and then
But
you
Patrick,
lean
don't
into
you
another
know
advance.
Europe is uninvestable? They
Yeah,
have too much bureaucracy.
they
There's
do.
no way you should ever put your money in Europe. Don't you
Absolutely.
remember all of those talks?
Yeah, it's
Don't you
crazy.
remember how
I
confident
I
everyone
I
was?
even
I
I
got
even
lectured
drank
all
some of
the
that Kool-Aid.
time about it. Like, oh,
I even
Europe is
drank that Kool-Aid.
uninvestable. And this is the part that I think is
Yeah,
hilarious is how, prices make opinions,
yeah,
right? Like we went and all that you needed was it for to rally. And then all of a sudden everyone forgets that Europe is supposedly
yeah.
uninvestable because of all the socialism and all the bureaucracy. Now all of a sudden everyone loves it and
Right.
they're all chasing it. So I just want everyone to remember that when you hear some sort of market narrative that everyone accepts as true,
Yes.
just keep that in the back of your mind, right? Because it's
Right.
something that's just like the more confident the group is about something, the more likely it's going to be wrong. And
Yeah. Yeah.
actually, Patrick, I saw this great chart the other day on from Goldman Sachs, and it was the amount of people at their they have a conference every year at the beginning of January. And it
Yeah.
was the amount of people in terms of their institutional clients that believe that the U.S. stocks would outperform the rest of the world. And so they have many years of data for this, like, going back 15 years or something like that. Usually it's 30, 40% or something like that. In 2023, remember, after that huge decline in 2022, it went down to 14%. Okay, so this was right before the U.S. went on one of the greatest 2-year rallies versus the rest of the world that we've ever seen. Guess what it was this year, Patrick? The previous highs were like 40%.
I don't know. Go for it.
58%. So I just put that out there, that when everyone is convinced to something, it's very difficult because you want to be part of the crowd. It's like it's human nature to feel comfortable because you're part of the crowd. But the more that it's easy, the more likely it is that it's going to be wrong. Anyways.
Yeah. It's I totally get your point. And
just remember that like 3 months ago, everyone hated Europe. Everyone.
Oh yeah.
And you got lectured about it's uninvestable. It's terrible. It's, the bureaucrats are running the country. Socialism, blah, 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 all these things. Now all of a sudden price changes and
everyone wants a piece of it.
Yeah.
Right. And it's interesting. Obviously, the German DAX has been one of the huge benefactors of that. Well, and so maybe, do you think that it could be the idea that it's now becoming clear, or has become clear, that Trump doesn't have the appetite to keep escalating with Russia, and if that war, whether you like the deal or not deal, whatever happens, but the likelihood that conflict comes to an end is increasing, right?
Well,
And if that does, and Russian gas starts flowing openly back into Europe, that suddenly one of the huge things that was a drag on their industrial complex may, in fact, reinvigorate them. And if maybe the market, could that be pricing something like that in?
Sure. Like, listen, there's a whole bunch of catalysts that have made the European stock market rally. But at the end of the day, Patrick, it was trading at 13 times next 12 months earnings, or 13 and a half. And the US is at 23. It was just cheap. That's all that it takes. And I've been arguing this for a while, that all you need is a return to bench for a lot of these managers, meaning selling some of their overweight US assets and return it to their home country. And you're going to get a lift on these countries. And you're going to get a lift in their currencies.
What is incredibly shocking, not shocking, but when I was, I spent the last 2 months traveling, but before, when I was in Europe, and I would just talk to other investors out there, it was very hard pressed to find someone, an actual European, that was actually invested in European stocks. Everyone's like, no, I just own the S&P. Like, literally, the retail investors literally just abandoned.
Forget retail, Patrick. It was institutional as well. I have a good friend of the show, a strategist that's based in Europe, that I won't name his name, but we used to laugh about it all the time, because he would go and get, like, I'd say something like, oh, I'm getting lectured about how you can only own American stocks. This was in the height of the AI kind of bubble when everyone was doing it. This is the last couple of months.
Yeah.
And he said the other day he got lectured by a Frenchman about how that you can't own European stocks and American stocks were the only thing to own.
Yeah.
And I bet you I should go back and look at our conversation, because I'll bet you that was the start of the European bull market, because nobody believed. They all hated it. They were all massively underweight US or European stocks.
Yeah. I hear you. And so here I have for instance, but it's all the indices. Like, this is the Italian 40, but the German DAX, they're all turning up. Even Greece got a little bit of a pulse. This is the Greek index, and like, Greek index is actually being bought. Something must be happening, right?
Well, I'll give you my theory of what's occurring, and it is actually Trump. Trump is forcing the rest of the world to change their fiscal stance.
Right.
he is saying we've had it with paying for everything. We've had it with being the reserve currency that, where we are running these huge trade deficits and we're running these big fiscal deficits. We're going to get both of those deficits down. And the rest of the world is looking at this and going, holy smokes, if this is true, then we're going to have to step up. And
Right.
ultimately, I think that this is part of what the market is sniffing out, an
Right.
increase in fiscal spending throughout the rest of the world. And that's ultimately why I think that in some ways it's going to be great for Europe, what all these tariff threats and things like that, because it means that they might finally start putting in place policies that are sustainable over the long run. And we're not
Yeah.
going to get the Germans trying to balance budgets, like
Yeah.
that's the real problem.
There you go. And so here, I want to look at some of the other international markets, and you can see the Nikkei really just has not wanted to join this party, and so you have it. It's deep in a trade range and quite inactive. The interesting part is where I was spectacularly wrong on a market call was I generally believed almost all global equity was going to correlate and that they were all going to either rise together or fall together. And it's literally the exact opposite that's happening. It's like literally, we are seeing, each global equity market almost marching to the beat of its own drum. It's like this doesn't give a shit what's happening elsewhere. It's I was completely not expecting this, but I'm curious whether this now becomes the unfolding reality for the rest of the year. Are we going to just see that each global equity market is going to completely break correlation, or maybe even be the benefactors of rotation, which is exactly the point you were trying to make earlier, which is that all that money is going to go from one and it's going to go into the other. And it's not going to be a risk on, risk off of all risk assets, but rather an outright rotation and shift in the way money is allocated around the world.
So I completely agree with that's what the new reality is. And I've been arguing this for a while. Ever since Trump got elected, I said, we're going back to the period of the 1970s and 80s when the Steinhardts and the Soroses of the world traded macro. And there was huge moves within asset classes, huge moves between
Yeah.
countries. And that is the new reality.
Right.
We're no longer going to get these all up, all down, basically just following America. We're going to get divergent monetary policies. We're going to get divergent foreign exchange rates. We're going to get all sorts of very exciting things, and that's
Yeah.
why I highly encourage everyone that's has focused on stocks, go start working a little harder on your macro, because I think it's going to matter more in the coming years and even in the next decade. We're increasingly at points where individual countries and individual government policies will um, diverge.
Right.
So I'm with you, Patrick. I really think that this is the new reality, and this is just
Yeah.
we're first innings, baby. That's like
There you go.
first innings of this.
So I want to talk China here for a moment because obviously, like when you look at something like K Web, right, and you're looking at some of the actual Chinese tech kind of influenced plays, they've really had a good month. Like that's a huge rip. But I want to look at the China A50 in as the a broader scope here of what's happening. What we had was obviously the Chinese bazooka that happened back in the September October window. And so after that bazooka fire, we've seen the whole market settle at a new elevated level, which has more or less been the 13. I'm going to put this actually on a weekly chart and really zoom out and look at this bear market in context. And we have a scenario where this may have been very likely the bottom of this China equity market. And if this is developing to being like one big Fibonacci retracement basing at new higher levels, this is where China could totally go and have a new rip. And so it'll be very interesting to see that this move that just started here on this China A50, is this the beginning of a new bull breakout? And it's a very simple way for our listeners to just track this. China has basically spent a month below its 50-day moving average in this consolidation. And if you look at all prior bull runs, it's been pretty consistently able to stay above the 50-day moving average when it's trending. And so we just literally got a couple closing days above this 50-day moving average. And if this rally is for real, then you should see it not return back underneath it. We should see that it's going to start building on this trend and start working. And if that's the case, then there's definitely room for some rotation into this space. You know, a lot of people like to trade it with the ETF FXI. You can see that that's the China large caps just starting to get some nice breakout action. It'll be interesting to see whether this is the start of the next leg.
I like it, Patrick. I like that rule. Just own it as it's above the moving average. That's simple.
Yeah, it's not always that simple, but
No, but sometimes it is.
But in this case, I think that this is it's a very good way of gauging whether you're on the right side of the trade. It kind of quickly fades back down below, then you know that this could have been just a fake out.
You know, Patrick, like I think Paul Tudor Jones said once, like if he was asked about like wisdom and trading wisdom, and he said something like, I buy stocks and assets that are above their 200-day moving average, and I sell them the ones that are below.
Yeah.
And then really like that, like I know there's more to it than that, but sometimes just being on the right side of the trend and not fighting it is all you need to know.
Yep. Yeah. I don't really like at all you making a binary buy sell decision on a 200-day moving average, but
but he's just saying
the respecting of the prevailing trend.
That's all he's saying.
Exactly.
He's just saying like, don't go. And Patrick, if you think about that, it stops you from bottom fishing. It stops you from trying to, catch things. And that's something you do all the time in terms of saying, no, I'm going to wait for this to base. Like I'm sitting there without any fingers and losing toes, still trying to catch things. And you're like, why are you bothering? Wait for it to tell you. And I think that's all that Tudor is saying is like, he's saying the same thing as you are, that wait for the market to confirm and to show you that it's going that way.
Right. Right. Okay. So let's move on and talk currencies for a bit. And then I want to talk rates and commodities. We got lots to cover here. So let's start off we'll keep the dollar stuff a little bit shorter because I think we talked about it quite a bit, but we're clearly in the midst of some sort of retracement in the dollar index, right? After such an extraordinary bull run, it is very typical for there to be mean reversion. But to the point here is that this could very easily just come back to 105, base at what were all of these previous highs now act like support, and the dollar could resume its bull trend after that. Like, let me put on a weekly chart. So like you could have a scenario where this comes back down here towards all of these previous highs, and then we'll still resume for a test of the 2022 high. Point is, it's too early to be already, calling an end to this. I know you're super bearish the dollar, but I still think the prevailing bull trend is still quite intact, and there's not enough evidence that this is already topped out. But there is that one currency pair that your currency whisperer there is bang on. Is that the yen feels very different. So when I pull up here, it really does start to look like it's rolling over. And I'm going to, for the sake, because we're talking the yen, I'm going to actually look at the yen US dollar so that we reverse and turn the chart upside down, because it's easier to look at the bull case when looking at the chart this way. I'm going to even put on a weekly chart, but it really, like, when you step back and recognize that this has now been basing and creating a bottoming formation, we're just seeing the potential turn point of a major bottom in a currency. Will this ultimately prevail, and will this be able to march to the beat of its own drum? Is something that I think is very interesting. It's one of those scenarios where I have a view on the US dollar against most currencies, but this yen is behaving like it wants to actually break out. And maybe we see a strengthening cycle here of meaningful strength in the yen, something that I'm sure you're going to be super excited about. And by the way, I haven't Gucci'd yet. I haven't taken a position, so you have actually a chance. You have a chance. Well, I'll tell you when I go long, and then you.
So you're telling me there's a chance?
There's a chance. No, actually, like, look at the way it retested this moving average, came right down into like a 50% retracement, bounced right off that 50-day moving average and ripped right back up. There's some sort of accumulation happening here. It looks better than most.
Okay, there you go.
Yeah, right.
I'm
And
not
so,
gonna. I won't go through it. I won't talk
all right,
about it.
I want to talk rates, but before we do, let's quickly talk a couple of these currencies. First of all, gold's been on fire and down $40 today, but this has been a huge gold rip on the upside. And now the question, of course, is will it bump its head temporarily as it approaches that very important round number of 3,000? And while I think that the gold bull is quite intact, and we could even see much higher prices as we move forward, uh, I we're overdue for one of these pauses. This is still a market, and at some stage, for us to have $100 to $200 pullback in gold is par for the course. It's done it over and over again. The bigger question: are we going to have that kind of test of that 50-day moving average, which is down near 2,800? Like, is there going to be a temporary pause? It'll be interesting to see, right? Like, the clearly turned down. And when you look at things like silver, silver had a big breakout attempt and gave it all back. And the interesting part is like the fact that silver has lagged to the degree that it has. If gold has finished this move, and we have not seen silver break out to fresh new highs, then I think that the entire silver rally is pushed forward, which is that it might not even happen in the first half of the year. I think that if gold here can make it to 3,000 and silver couldn't break out in that frame, then the likelihood that silver breaks out here and going into March is a much smaller window. And I think that there's an increasing chance that it's just going to continue to churn in a trade range until maybe somewhere in the second quarter or third quarter, or going into the second half of the year, where if there's another major leg higher, then silver could probably, in a more meaningful way, participate. Any comment on that?
No, listen, I understand all your arguments. I still think that longer term, you have to make sure you're long. And the worst thing that can happen in a bull market is you give away your long trying to
Yeah.
play for a squiggle. So
Yeah.
I'm worried about that. Having said that,
The way I deal with that, is I put very short-term collars onto my core gold position. That way, I'm never shaken out of my main core long, right? Like, I have my main position, and when I think that there's a technical reason there could be a pullback, I just wrap it in there so that I don't get shaken out of my long-term position.
And if
But
you want to
have
learn
to,
more about that, go to bigpicturetrading.ca to
oh,
learn about how Patrick deals
it's
with that.
.com. Okay, you
Oh, sorry,
wanker.
.com. You
What a
think if I'm going to
wanker.
do the
Just,
plug, I should
yeah,
get it
you
right.
go do the plug, send them to the right fucking website. Jesus Christ. All right.
So wait, before we get off of this, I just wanted to, the guys in my chat were highlighting that Joe Weisenthal from Odd Lots, great guy. He has a piece where he's wearing this Odd Lots recent one where he goes to some sort of jewelry store and he puts on this big, huge gold necklace. And they're like, if we top, it's going to be Joe's fault. And so that's all I'm going to say is if we do top, it's going to be the Weisenthal top, and we can all blame Joe.
There we go. All right. Let me ask you something. Just your opinion on this. Um, Gold obviously has a central bank tailwind. And now, with the way that everyone's talking about the way the U.S. may want to restructure things, there's obviously going to be a persistent bid on gold from central banks as diversifying their holdings into gold will continue. But they don't buy silver. And so traditionally, silver has been the poor man's gold, which is it's been where the average retail investor goes to in that. But to me, the retail investors now are far more obsessed with crypto than they are with precious metals. And so I wonder, if silver's not going to get a central bank tailwind, then it's fighting for money, retail money that is being, sprinkled across the entire crypto space and not just focused like it was in the past in silver. Could that ultimately drive the fact that we never see a reversion of the gold silver ratio back to levels where it was in the past. Like, will silver just be a laggard in general just because of that?
So silver bulls rejoice. Patrick asking this question is probably the most bullish thing that could happen for your. I hear your argument. I think silver will increasingly trade on, like there'll be a little bit of the industrial usage to it. So
Yeah.
I think it is slightly different in terms of it goes into solar panels. And not only that, it's also a byproduct of a lot of copper mining. And we know the copper mining is actually declining on a relative basis. So I think that they're slightly different. But I do agree that I would argue that even since the advent of ETFs, that the gold silver ratio and the fact that people buy silver because it's a cheaper price is gone. Because let's face it, once you could trade these things easily, there was no point in you could buy,
No.
10 shares of GLD or 100 shares of SLV. What does it really matter? In the old days, it was because if you were going out and you were going to buy, one, a silver coin or 5 silver coins, you could actually get something that was more substantial, and therefore you would go buy silver. And nowadays that doesn't matter. So I am sympathetic to your argument, but I do think that silver is trading on its own fundamentals, and that it very well, it feels better than you're making it to sound like. I actually feel like this last rally, silver's led over the short run. Like silver
Okay,
is
like on a very short run basis.
yeah,
Like,
on a very
what?
short race.
Oh, come on! Like, what? This little move right here is what you're talking
Yeah,
about?
I'm just saying recently it's feeling a lot better.
Come on, that's pretty pathetic.
No, I get it. I understand what you're saying. And it's got a lot more zip. So that's, I guess, the one thing I will say about this.
I've been
in terms
leaning
of
into weekly
people
income rights
that
on
are
silver, and it's been
actually
perfect.
trying to trade this, silver's got a lot more volatility. So there
Yeah.
might be people that are attracted to it for that reason. And
Yeah.
I probably should have I underestimated that possibility.
Right.
But
Okay.
you know what? One thing, just while we're on this topic about central banks buying gold, one of the things that I worry about is that what if the U.S. revalues their gold from 42 or whatever it is on the treasury sheets to some sort of, like, let's say $2,500, and then uses a little bit of that gain that they've just realized to sell gold and buy crypto. And I don't think you should. That is, to me, the short-term bearish gold argument is that they're going to revalue it, sell some to basically honor their crypto reserve commitment that they've made to their broligarchs. Okay. And I could see you wake up and gold is down $300 because of that. And all I will say to you, Patrick, is if that happens, add to your gold. I don't know if it's that day, that morning, or 2 days later. Who knows? But that won't be the time to panic and sell your gold. That will be the time to buy more gold.
All right. I like it. Let's see if that kind of a storyline plays out. Let's talk quickly copper. Copper had a pretty solid breakout. And so, when we step back, here I'll put on a weekly chart. We had this 1 year little pause in copper's advance, and we got a legit breakout out of this consolidation to the upside. And so the question is did copper wake up into starting some sort of a new bull cycle in here? The reason I find this interesting is because copper miners have just so far not given a shit.
It's not just copper miners, to be fair. It's all miners.
Yeah.
Like gold miners is the same story.
Well, gold miners like Agnico Eagle are ripping 52-week highs, dude.
Okay, but that's you're picking the best one, and there's a lot more going on. There's the currency's helping with that in terms.
Yeah, but
like the
nuances,
GDX as a whole is like, you
But
should
compare
hear the
compare the
moaning I hear
GDX.
from everyone complaining about gold miners underperforming the gold.
Sure, but performing though. Notice here the Freeport McMoran is at its just off of its 52-week low, right? This is like gold miners is there been complaining that it's not making enough on the upside, like they should be
Whereas
doing
coppers
better.
really suck, you're saying.
Yeah, well, I'm just saying copper hasn't even left the. This is not even the first inning of the of a move, and so the question here is if copper is legitimately starting something more bullish, then these copper miners they haven't even turned yet. Like look at Southern Copper here. It's just the first couple closes above the 50-day moving average after basing. Like if if you want use that analogy, that you go into these trades in the second inning of the game once the game has started. Well, this game hasn't even started. This is like very early first inning. If this is a turn, copper stocks might just start to come wake up here.
I
It's
like
a
it, Patrick. I like it.
it's
When
it's
you have these little insights sometimes, and I'm with you.
sometimes.
Sometimes. When you're
The
not
other thing,
busy, talking about dollar going up or
there you
here,
go.
you know what? Let's fix that. Let's talk about rates.
Yeah. No, let's do this. Let's fix that.
It's something I can disagree with you on.
Yeah, right. So let's just quickly. I want to touch on two more quick things in commodities before we go to rates.
Okay.
Number one, nat gas. It just keeps going. So this is the 12-month nat gas strip.
And
Lovely
kudos
ETF.
to you. You highlighted this and you said you should keep your eyes on it. It's looking good and it continues to look good. Well done, buddy.
Well, you're the one who actually was super bullish this. So the fact that it's working
But
and
I'm
while both
always
of us were,
bullish, so it doesn't
yeah,
really count.
it doesn't really count. But anyway, it really does feel like this could break out. And so it's interesting is that even though most energy stocks are continuing to struggle, a lot of these nat gas stocks are actually behaving very well, like EQT and Range Resources. Like these stocks, are bucking the trend of what other resource names are doing. Yeah, like let's say look at Range Resources here. These things continue to be up along 52-week highs. It'll be interesting to see whether this natural gas stock trend can continue to diverge and continue to work well, in spite of the fact that oil's stuck in the mud and trade range bound. The last thing I want to touch on is uranium, and boy, has this been a cold bucket of water on those people that have been like uber bullish uranium in this last year or two, because when it was over a year ago, like 13 months ago, when this Sprott Physical Uranium Trust peaked out. And since then, no matter how much you want to build a fundamental for uranium, you have seen yellow cake just bleeding. And it's been systematic, not even just a quick correction. It's just going lower and lower systematically. Now, this is now trading at a deeper discount to its net asset value. But overall, there's nobody that's interested in this. And it's almost like depressed selling in this trust.
Yeah. I've been saying avoid it for a while because it felt like a hedge fund hotel to me. I'm just pulling up the NAV. Still only 8%. So the reality is that it could get worse.
It could get worse. But look at the way it's being distributed. Lower highs, lower lows. It's like it pops for 2 days and immediately someone
But
leans
isn't this though, like Cameco is doing okay, isn't it? Let's just pull up that
that's
chart.
the interesting part. Like, so,
because and this is what I've always said is that when the big guys come for this, they're not buying U.UN or SPUT.
Yeah, they have to buy the big boy.
They have to buy the big one. And that's like, so it ended up being Cameco was the way to play this.
But you know what? This is now a month trading below the 50-day moving average, sitting right at a fib zone. And if this breaks to a lower low, then the entire uranium story could be dead in the water for the first half of the year.
Here's a question for you. My understanding is that there was a lot of guys hiding in the uranium, the utilities, all those sorts of trades, expecting that to be a way to play the AI rollout in a less dangerous way. And I was
bailing on it.
Right. And I was out with a guy the other day, a big money manager, and he said to me, I was shocked at the pain that was occurred on the day of that DeepSeek thing. Like when we had the news about DeepSeek, a lot of those utilities were actually down more than NVIDIA was. And what that said to him was that there was a lot of hiding in those names, meaning people that weren't prepared to pay the obscene prices for NVIDIA were hiding in these names. And I wonder to some extent if that's also what's happening in the uranium market across the board.
I think so. I
yeah.
no, I listen. I think so. Yeah, I feel ultimately that the long-term bull story is quite intact. But the thing is that it became so popular that I
Yes.
feel that it needs to almost wash everyone out from boredom. Just
By
people are
the
like,
it could be
not
as well.
moving.
If we got a sell off in the actual market, then these guys would come for the U.UN and sell it. Because one thing I did learn I'll tell you a mistake I made during COVID. I remember getting bearish the market and trying to find places to hide. And I said, oh, I'll buy U.UN because that's not like it's an uncorrelated asset. It's not going to move with all this. It doesn't really matter. And then what happened was guys needed to raise cash. They were long U.UN. They went to like a stupid discount, record wide discount. And so ultimately, that's what I'm worried about. And I'll tell you this, the time to buy this is when it goes back to a record discount. I think that the low was 15.7. So for those that are looking for timing, when we get back to 15, start looking then. That'll be your sign that it's getting washed out.
It adds a little bit of asymmetry to your trade by having a discount to the NAV.
Right. And it's also, I use it as a sentiment indicator.
I like that.
Yeah.
Is there an easy way to chart that or you just track it on?
You know what? If anybody knows, please put it in the comments. I think there is some Twitter handle or something like that. I pull it up on the Bloomy, but I'm sure there is some other way.
All right. Let's talk rates, buddy.
All right, here we go. I love it.
All right. So let's first of all just touch on the 10-year yield. And what particularly I thought was super interesting was as we drop down to 440, I rarely does a major rate shift happen without some sort of a retest. As an example, look at the way the high came in April of last year, right? Which is the rates reached around this 480 on the upside. They sold off on the downside in this correction, but then there was this pop and drop that happened to retest the high, a key top retest that basically sends rates up to kind of solidify that there's a top in rates and a bottom in bonds, and then starts a bond move. So what was interesting is we got that pop and drop off of the CPI number. When the CPI number came in hot, the bonds just hammered to the downside, yield shot up, and look how quickly it faded off of that. That to me actually increases the probability that we've seen some sort of intermediate swing high in yields at this upper range, and that bonds got something in store for at least some reversion of this move. I keep want to remind, like, I know I take a bullish bond stance, but I want to highlight the difference. I mean, I said it numerous times on the show. I think there's a tradable opportunity in bonds. This is not a me being bullish that I think we're going back to 2% or 1% rates as deflation will, bring us back to the way things were in the past decade. I just think that rates are very high and bonds are very cheap, and there's lots of room for in a trade range bound market for us to see rates back down to where they were just 6 months ago. I think that we can bounce around these kind of ranges, and therefore I'm speculating here as to whether or not we've seen the turn point in bonds. So this is the long bond here in terms of the futures. Can we go back to 120, 125? I totally think we can. And we were there just 6 months ago, and I think there's a trade here.
Well, I guess I have to say it again. You're what was my line? I said something. You're not making as little sense as you usually do. I think that I say something like that.
Thank you for the compliment. You're such a gentleman.
I think for bonds, it's a complicated thing because the reality is if we get a situation where they actually cut the fiscal deficit and they end up slowing the economy, then I could see a situation where um, it makes sense to own bonds. And all things being equal, if that was the only thing that was occurring, I might even come into your camp and say that you should buy bonds. The trouble is that it's also accompanied by tariffs. So
But
we have this situation where you could have prices rising, yet demand or activity falling. And so what do you do in that environment? It's really, really difficult because you're kind of, doing this. So a couple of things. First of all, Patrick, I'm going to do a shameless plug, and I very rarely do this. My inflation break-even strategy, the one that I harp and harp and harp about, it just hit a new high. And for those that are interested, email me, kevin@themacrotourist.com. I want to get an ETF going on this. I feel like this is something that should be trading. Send me some, if you're interested in learning more, send me an email. I'll hook you guys up with the article I wrote and the chat about it. And if you're an institution that wants this strategy, reach out
yeah,
because I think that this is the time for this trade is here. This is the way to play it. Inflation break evens have been one of the best sharps out there. They continue to work. We're all sitting here trying to, play bonds in this environment of kind of slower growth, yet higher inflation. It's like it's a mugs game. Second thing I will do, Patrick, I'm going to say another shameless plug. Not a plug. This is actually more a kind of a fess up. Like we're in the trust tree, right? You and I were in the trust tree. I've been cheating on you because I'm fed up with you cheating on me. And
okay.
I went yesterday and I the guys at Zero Hedge, as much as
Yeah.
I like to make fun of the doomers. They asked me to moderate a panel on the VIX, and one of the guys on there was Harley Bassman, and I'm like, okay, anytime I get to chat with Harley, I'm in.
You're in.
Yeah. And so I got a chance to talk with Harley. The reason I'm bringing this up is because at the end, he was summing up his kind of macro view. And one of the things that he said was, I'm a big believer in higher for longer. And
Or
I
interest
think that
rates?
makes a lot of sense. The reality is that it's going to be difficult. And so we're sitting around talking about, yes, maybe bonds go to from 4.25, 4.5 to 4. And we're playing all these games. But I just think it's kind of like a mugs game. Like, I don't think it's going to be that exciting. And you might be right. You're trading squiggles. I'm not disagreeing with you. As I say, I think the U.S. economy is about to slow down / roll over. Therefore, I could see a situation where you have bonds actually rally for a while. The trouble is, over the long run, I don't think that they're good purchases because
Yeah, I get it. No,
yeah.
I agree.
But the only thing is, like when I first used to talk about being short bonds, they were yielding 2%. The carry on them was extremely low. Nowadays, with the bonds at 4.5 or 4.25, whatever, the carry's like difficult. And not only that, the Fed's making it so it's a lot more difficult because if they start actually lowering rates, which they shouldn't be, but let's just face it, they might, then it ends up being that this trade doesn't work as well. The only thing I will say to you, Patrick, is that, and I talked about this yesterday with Harley. I think the time for MTBA is here, which is his mortgage-backed product. Because although I do think there's going to be volatility in a lot of different things going forward, I think that fixed income vol has been elevated for a long time. And although that chart doesn't look as good, you have to look at it with the total return in there because it pays a dividend.
Mhm.
And I really think that mortgage spreads are very attractive. And, Harley, who loves being long volatility, is short volatility with this MTBA product. I love it. I think he's going to be right. And if he gets his higher for longer and we get a steepening of the yield curve and a million different things,
Yeah.
this will be the winner. Anyways, that's
Listen,
my 2 cents about it.
it's paying 6%, and it is on the down low. I mean, it's behaving like a lot of the other bonds, and so
Well, except that you got to look at the total yield on that. Like when I pulled up the the actual like total yield. Let me just pull it up here. Not total yield, the total return. I'm speaking incorrectly. Let me just pull it up.
Yeah.
So although, it looks like it's not doing that well, but since inception, okay, it's actually up 7%. So this thing's it's not the worst. It's not as bad as it looks.
No.
This is the other problem with the bonds is we sit around talking about all these things and we don't too often people don't take into account the carry.
Right.
And I remember like the one thing I will remember is that the CNY, which was the renminbi.
Yeah.
I remember watching all these guys talk about the chart and things like that. And then Louis Vincent Gav, friend of the show, terrific guy, he emailed me this chart. He says, here is the CNY total return over the last 5 or 10 years. And I was like blown away. It went from this chart that seemed to be going, not moving that much to being the absolute best return currency out there. And so this is the thing with bonds. We need to be aware that when you're just looking at these yields, you need to take into account the total return. You need to look at the carry.
Yeah.
You need to look at what the forward rate is. And just to your point, Patrick, I think that there's probably easier trades out there than owning bonds. That's all I'm going to say.
Okay.
Do you want to talk about the front end of the curve?
I do. I absolutely do.
Okay.
But the one thing that I would say is that for somebody that is outright bearish the equity markets, when you say there's better trades out there, I don't know. Like it seems like a pretty good place to be hiding a little bit of your capital when you're trying to sprinkle outside of the U.S. equity market. Okay. Anyway,
except I might just argue you'd be better off just sitting in cash. Because this is what I worry about. This is my worry about the bond market.
So
one second. Can I just tell you this? My worry.
Yeah.
Okay. I know I've hijacked your.
No. Listen,
okay.
I want to talk about this.
So what I worry about is if we get a situation where, let's say, the economy rolls over, the Fed cuts rates to 3%, 2.5%. Okay. We get that situation. Well, what happens as the Fed cuts rates is that the yield curve steepens. The yield curve usually on 210s steepens
so let's put that
to 200 basis points. So we could get a situation where the Fed could cut to 2.5 and 10s will be 4.5.
Yeah,
so they'll go nowhere.
Kick.
Yeah. So it'll go nowhere. And you just you'll earn your coupon or whatever, which will be fine. It won't be the end of the world, but it's not the big winner that it was in the past. And that's what I worry about. Okay, so let's talk. You wanted to talk about stuff.
Well, first of all, here's the 210s, right? And what's interesting is we literally did spend, below the zero line. What was that? A total of 800 days. It was several years that we had the inversion. And we for the first time have seen us enter a sustained period of several months of trading at outside the inversion, and once again in a positive yield curve spread. So what's your take? Do we stay above zero now? Is this now going to be a new trend in your mind?
I think it's really tough. And this is my point. I think bonds are very difficult here because it's going to depend a lot about what Trump does.
Yes.
So if you told me you knew what Trump was going to do, then that'd be one thing. And then next thing, how does the Fed react to it?
Yeah.
And
well, let's dig into the SOFRs, because this is exactly like SOFR futures. Let's talk about where all these interest rates are. Because, so here we have the 3-month SOFR out to March, right? So we're talking about them pricing right now, 430 basis points into where the level we are on the yields. There's this, still this chance that there's going to be one rate cut in there. But what I am shocked at is the fact that the market has literally now pricing in flat interest rates 2 years forward. So like the December contract is at 4%, 400 points. And the December 2026 is also at 4%. Basically, going 2 years out, we're talking about a flat interest rate environment being currently priced in. Well, how are you interpreting this? Am I just looking at this too simple?
I'm just pulling up the WIRP, and it's got 50 basis points of cuts out to January of 2027. So you're saying that the SOFR curve is different? Let me just.
Well, I'm just saying, like, look, this is the December 2026 SOFR, and it's trading at 96. Like, we're talking about them anticipating rates being more or less around 4%, priced out to there.
1 second. Let me just pull up the curve because I wasn't ready for this.
Yeah.
So today see, that's the problem. So today we're 95.65.
Yeah.
And you're saying, like, so 2 years from now is December of 26, and that's 96.10.
Yeah.
So they have 50. They have 50 basis points of easing in.
Yeah.
So
okay, but okay, 50 points of easing. But the point is that the difference between December 2025 and December 2026 is almost no change. So yeah,
okay.
there is.
So yes, you're correct that they are pricing in the easing to occur in the next year, and then it's flat. But Patrick, that's not. This is a return to more normal markets.
Right.
Like it used to be that you'd have an upward rising yield curve, and you would always kind of, like, I remember my days when I was at the bank and I would be trading index futures, stock index futures, and we had to fund our index futures. It always made sense for us to just fund it in the overnight because the rate 3 months out was always so much higher. So unless the in our case, the Bank of Canada went and got really super aggressive, we were almost always better off, letting it ride in our funding, letting it ride in the overnight. And this has kind of been an unusual period where we would have this inverted curve and the market always pricing in worries about lower rates in the future. And I think that this is a couple of different things. One, I think it's a function of the fact that we went from a scarce reserve system in the Federal Reserve to abundant reserves. And then I also think it's just the leftover of all the bond bulls that still get excited about the possibility of something really happening and, the Fed having to cut to 1%.
Well,
So
now let's have this conversation. I want
Okay.
to literally the point that I was going to try to get to, and since you said it, I think let's cut in there and talk about it. So I'm going to just push out to the 2026 because I want something that's more than a year out.
Okay.
Because if the Fed goes through a cut cycle, you want something that is going to encompass an entire cycle. And so obviously when the stock market bottomed in 2023 based on Fed pivoting and anticipation of Fed pivoting, you had them suddenly price in virtually even 2% of cuts. The SOFR futures go ripping as everyone's anticipating the Fed rate cut cycle has to kick in. Then it mean reverted all the way back to virtually them anticipating by March or April that the Fed was going to do nothing. And then again, when we got the big yen carry trade unwind, suddenly we have another huge rip on the upside where they suddenly once again priced in, a 200 basis point rate cut cycle or something. And I'm rounding, but like they priced it in. And then they pulled it right out again. The thing is that I'm not so sure Trump is as bullish for the economy as everyone is making it out to be. And there is a very reasonable chance that there's going to be economic consequences felt in this period. And if we in any way start seeing the economy crack based upon all of these policies and everything, what if they go? What's your odds here that the market goes and once again prices in 100 to 200 basis points of cuts that is currently, and they're anticipating the Fed doing nothing for the next 2 years? And what if we just get into a cycle where, holy shit, maybe the market needs to start pricing in a rate cut cycle? This might be a huge opportunity, in my opinion.
Okay, so first of all, you keep saying the Fed doing nothing for the next 2 years. That's not correct. if they're not pricing in anything, the Fed doing more than the 50 basis points over the
Yeah.
next few things.
Yeah.
But you are spot on correct, Patrick, that the chances of the market going back to this point where they're pricing in 8 cuts. Like, you remember when we were pricing
Yeah.
in 8 cuts? Like,
Yeah.
everyone was freaked out about it and they were like pricing in 8 cuts.
That was
I'm
back
with you. And in fact, if I was to wanting to hedge a risk portfolio, I would argue that that part of the curve is what you want to own. Doesn't mean the Fed will actually do it,
Yeah.
but I
No,
think that
it's
the market will price that in. So, Patrick, I love it. I love the idea. I think that really what you should be doing almost is like buying call option on 2-year notes. That's what
well,
you should own.
or like like Harley's QA,
Yeah,
like
but
it's
that's
the
a
way.
little different because that's not call options. That's
Yeah,
leverage trading.
so, but
And so,
you're talking about just, but like now that's a good question then. Okay, so do you think that going? I find that SOFR futures are far easier to understand, and even the options chains are cleaner than the 2-year Treasury futures.
sure, you can do
And so,
it's yeah.
like to me, when putting on this trade, it actually comes across much easier to understand when using SOFR futures. Now, do you think that there's an advantage in going to the 2-year Treasury over
No, I just have a tendency to
to
trade
do
the
that?
treasuries. Like, but
Yeah,
you're absolutely correct. It's way easier to understand. It's expressed in basis points, so you can see how it should cost you. It's the right trade. But
it's
Patrick,
cleaner
the
for
one
a retail
right.
fool like
So
me, like as opposed to
yeah.
a bond guru like
Listen, it
you.
might it's probably the right trade to do it that way. And our buddy Alex Manzera from RJ O'Brien,
Yeah,
like they do nothing but these sorts of trades.
yeah,
One thing I will just kind of that I want to explain though, in terms of when you're looking at that December 2026 contract, people will say the market is pricing in 50 basis points of cuts, right? And
right.
they'll think but that's technically not correct. What they're pricing in, if you go look at like the like we'd have to pull it up and figure out the math, but they might be pricing in a 10% chance of a move of 200 or 300 basis points of cuts, 50% chance of no cut, and then a 40%, 50% chance of one raise, right? The reality is that the distribution of that is different than it seems. So you can't just say that this is what the market expects, because it's what the kind of the risk adjusted different outcomes suggest.
Yeah,
But I am with you, Patrick, that if you were looking for a severe slowdown in the U.S. economy and maybe also problems with the U.S. stock market, that I would feel more comfortable betting on December 2026 or 2027 SOFR futures than I would on buying 10-year notes. I think
I
that's a much better trade.
I think so too.
Yeah. No,
Because but I think also you have to ask what's your investment theme, because if your investment theme is oriented around what the Fed is going to do, then the 10-year is not where you should be. Yeah,
right.
the
Because
SOFR
they
should
don't
be
control the 10-year. And not
exactly
only that, they could be too easy and then actually cause the 10-year to go up in yield, down in price, which is
yeah
what we just saw over the last, ever since the Fed started cutting. The reality is that the Fed cut 125 basis points or whatever it was, and the 10-year went up to 100 basis
right.
points. It was something like that. And so you need to be careful about assuming that the long end is going to be where you're going to play. So yeah, Patrick, you're speaking my language. We're
Right.
not on different stuff there. And I love the fact that you're highlighting how the market went ahead and priced in all these cuts. And even if they didn't materialize, that doesn't mean you couldn't trade that,
Yeah.
right? Because the reality is that twice, and you're absolutely spot on, they priced in 8 to 10 cuts. So as a
Why
trader,
can't it happen again?
you're absolutely right. And it might not be that they might never cut 8 to 10 times, but the market might price it in again.
Yeah. I think that's a real possibility,
Yeah.
especially if
The
we
only
start
thing
seeing
that
it
I
drop.
might argue is that that was under the Biden administration,
Yeah,
where both people were overly pessimistic about the economic activity. So you had an overwhelming pessimism in terms of, the policies and whether they would work. And now we don't have that same sort of pessimism.
right.
But then again, you could argue that this means that it's actually more likely to happen because now everybody's all in on risk assets. And if we did, by some unbelievable fluke, have a downtime in the stock market, then they'll be rushing in and pricing that in again. But
Right.
that's the trade.
Right.
I agree with you,
Oh, there you
Patrick.
go. So last thing I want to touch on, and then we'll call it thing is just I want to look at junk bonds and credits and the
Okay.
credit spread. So we obviously had it back in December a pretty nasty drop in junk bonds. They the first time they cracked in a while, but we've now made it back into that trade range. And when we look at credit spreads on junk, we're still pinned right along decade lows in terms of this. And if anyone's looking for a canary in the coal mine when things are cracking, it would be when this starts to price a bigger risk premium in owning this crap. And really at this moment, there's zero sign of it. There's
Yep.
zero sign of it, and so this canary is not dead. This canary is
Is
alive
she,
and
is
flying.
she singing and flying around the cage with
Exactly.
extra vigor? Yep.
Exactly. And so, at least this one metric is still not yet triggered. And it'll be interesting to see if and when at some point that becomes in play.
Way back when I wrote a piece, Patrick, that showed that you get plenty of 10% corrections when credit spreads are behaving well, but you get almost no 20% corrections
Without
without credit spreads widening.
right.
Meaning
And
that there's lots of 10s, but the difference between a 10
what
and
is it?
20 in the equity in the equity market is what credit spreads do. And it
So
doesn't need to be, it just they could start selling off together.
yeah,
Right. And so it doesn't need
yeah,
to be that they have to go up first. They could just go together, but watch for those signs. So if we get a
that
situation where all of a sudden things get a little dicey and the stock market gets a little troubling and you're wondering, hey, is this a dip to buy or not? And then you go look at credit spreads and they're behaving well, then that, gives you more confidence. Having said that, if you go look at it and credit spreads are blowing out and they're behaving poorly and they seem to be leading, then that's the one you worry about. So I'm
that's the
with you,
one
Patrick.
to
Yeah.
open up the
Yep.
downside, and there's no sign of it right now. There you go.
Correct.
That's
All
it.
right.
That's all I got, buddy.
It's awesome. Great stuff, Patrick.
All right. So let's bring the show to a wrap here.
All right, folks. Thanks for tuning in. Patrick, where can they find more of this great analysis?
To bigpicturetrading.com and
Not
Kev,
.ca, right? Not
not
.ca.
not .ca. not .ca. And Kev, where can they follow your
I
great
think go check me out at themacrotourist.com. And listen, bear market, bull market, we're just happy everyone spent some time together on this crazy ride. So stick around for the after show. All right, Daniel.
All right.
Daniel's looking very suave today, by the way.
Yeah,
He's
absolutely.
looking like us, like just making us look badly,
Oh,
Look, I wanted to make an effort for you boys.
He did.
yeah, there you go.
My camera's gone. Okay.
Yeah, now he's out. Now that I say that, it's gone out of focus. Like the market, the AI is listening.
Oh, there we go. There we go.
There we go.
So I was in Miami doing my big mastermind last week, and I flew into Toronto to stop over for a week just to see friends and family before heading thing. I come here, what a shit storm of weather! Like it is dumping, like it kicks in 30 centimeters of snow. And there's another 30 centimeters coming in the next 2 days. Okay?
Yeah. One of my
Like-
buddies was talking about how soft we've gotten and how they close schools. And he's like, in my day, like, we wouldn't have closed schools like that. And then I asked him, did you like walk to school uphill both ways as well? Like walk to and from school, like, chest high snow uphill both ways.
I think just teachers want a day off. Like,
Well,
so, like,
I do think as well that especially on Toronto, we have people from all over the world, and so I don't know if everybody is as comfortable in snow as like
yeah.
as the ones that have been here for a while. We know
All I
we
know
should.
is I want to go see Danny in Lisbon. Like, get me out.
You're
of
like
this.
tapping out.
Yeah, I'm definitely tapping out.
It's definitely a little bit warmer here, guys. Just so you know.
What's the temperature there today?
20. I think it's 20. Where I am, it's like 21 maybe, and it's like I was sunbathing the other day.
Oh,
and it doesn't look like it, but like I was like fully sunbathing. I was like, brilliant.
There you go. Well,
sorry guys.
I got to get the hell out of here. It's literally that snow dump might cancel the freaking flight. And
did you? You can't get out now? Like,
no, I don't know. No, I didn't know. I said
when are you flying out?
On Sunday, right in the middle of the dump.
They'll fly out. One of my buddies on my desk, he flew out yesterday morning.
Yeah.
Or no, this morning. Anyways, whatever day the snow. No, yesterday morning he flew out, and it was like it was in the heart of the storm. Like, we're used to it. They can do it.
They can do it. Absolutely.
Yeah, there's no problem that way.
In the UK, everything would be shut. Everything would be shut down by this point.
But listen, I don't know about these Portuguese pilots. If they can handle these snowy runways.
That's true. They're like, what the hell is this?
Anyway.
I've been addicted to I kind of clicked on one of these at one point on YouTube, and now it just serves me out nothing but basically like the ATAC like transmissions of just kind of emergency events.
Right.
And like, I'm shocked at the stuff that goes on and how good they are at dealing with it. Like the bird hits the engine. They're like, oh, we got to come back and stuff like our emergency. There's smoke in the cockpit and they're like really calm about it all. And like, and I'm like, listen to it all. It's fascinating. It actually, strangely enough, it's made me more comfortable flying, not less.
Nice.
Yeah.
Very good.
So for those who are interested, go to ATAC and just go through them. And it's like, it happens all the time. Like, it's shocking. Like, it really, like, bird hits the engine. Oh, well, we got this engine out, or we got, smoke in the thing. Or they get, like, one of the pilots dies. That happened. Right. Like, the guy had a heart attack. Yeah, the guy had a heart attack. And like and then the problem is that I didn't realize this, but you can't steer the plane in terms of once it gets on the ground from both seats.
Right.
So like once it landed, they had to like move him to like, they're like moving the dead dude. Anyways, pretty fascinating. That's a little morbid. Let's talk about something more fun. What should we talk about? How was Miami? That's a good topic. How was Miami? You saw our buddy Cuppy. Did you guys your liver?
Oh yeah, absolutely. I had dinner with Cuppy. We shot the shit about all sorts of stuff.
Shot the shit.
I didn't want to pull that up, Pat, but I was thinking "shot the shit," and I was like, okay.
Yeah, that's it. We still named our episodes. That's what we should call it.
I shot the shit.
Okay, so you shot the shit. What did he have to say?
Well, I mean, he was talking his book as always. It's that's Cuppy's Cuppy, but no, actually, it was a really funny story. So his CFO Paul was there, and he's got a thick like Lithuanian accent or something. I apologize if I got the wrong country right there, but like a thick Eastern European accent. And so we go to this club. Not club, it's like a bar, not a club.
It's not a club.
Yeah, a bar, and the bouncer basically kind of story we're full, and he pulls like a complete Ron Burgundy. He goes, I don't know if you know who we are, but we're a hedge fund guys. And I turn to Luke. I'm like, that's never gonna fucking work. Yeah. And then this guy goes, and then the bouncer goes, okay, wait 1 second, and he fucking got us in.
Come on, just say we're hedge fund guys.
And like literally, it sounded exactly like it was like Ron Burgundy giving this thing, and I'm like, that's never fucking gonna work. And yet, it's like, oh no, okay, come on in over here. It's like, I can't believe that worked. Like now I'm going to use that flex all the time. I don't know if you know who we are, but I'm kind of a
Oh
big deal,
my
you know.
God. Okay. It reminds me of a story. I'm just going to pull it up here and see if I can find this. Let me see if I got it here. Okay.
Now all our listeners are going to pull this one. It's like every
So
bounce
listen to this story, and I'll skip the guy's name, but there's a very famous hedge fund in Canada that's done really well with the pot stocks. And here, let me just hedge fund manager XYZ was near the end of a pre-St. Patrick's Day party blitz when he allegedly bought cocaine for a woman at a Toronto after-hours club. Unfortunately for the 32-year-old executive at ABC Management, one of the Canada's top performing funds, the woman was an undercover cop. Okay. And so then when they asked him, let me just see here where they said what they basically, let me just see. Oh, they don't have the quote. The stupid thing. They basically asked him, like, why did you do this? And he's like, well, I'm a hedge fund manager. What was his answer?
What? You don't
Like
do cocaine?
it was like, oh, I'm a hedge fund manager. And I was like, what? Or maybe it was like,
that explains everything.
why did you have so much cash on you or something? It was something. Oh, here it is. Yeah, that's it. Sources say that Mr. X, FGH, who lives in a nearby loft, tried to explain the $600 cash in his pockets to the police by saying, I'm a hedge fund manager.
Brilliant.
It's awesome. Like, there you go. That's all you have to say. I'm a hedge fund manager.
Yeah, that's clearly now like every bouncer now is going to hear this used by every one of our listeners who's going to go pull some flex.
That's right. I'm a hedge fund manager. Yeah. Okay, well, that's it. You got anything planned for this next couple of weeks? How about you, Daniel? Let's get you involved.
What plans for the next couple of weeks?
Yeah.
I'm really boring, guys. I'm so sorry.
Dude, what do you mean? You're coming to the Rum Shack in Lisbon.
Sorry, yes, of course. Next week, next Saturday, we're going
I'm
to
throwing
the Rum Shack.
I'm throwing a party, baby.
In Lisbon.
Yeah.
In Lisbon,
Okay, and what's the party for? And why wasn't I invited?
It's for Patrick. It's just for Patrick.
Because he's back.
I'm back. 2 months of traveling. You got to get the crew all back together and hash down. And also one of the buddies is moving out to Italy, and so it's like a little going away party for him as well. But it's mostly for me.
Okay. Well, there you go. We'll have to hear about the Rum Shack guy going to Italy, but really just a party for Patrick. Next week. Have fun, boys.
Absolutely. All right.
Take care, everyone.
Thanks, everyone. Have a great weekend.